Thank you, George. Now, this being a dinner, it comes with 3 courses. And I'm supposed to talk a little bit about the credit crisis and some of the lessons from that, and I will do that, but do that fairly quickly. For the main course, though, I want to talk about the need for a new paradigm. And this is where I will get into the area of forecasting, but I don't just want to think here about forecasts, but about what we do with forecasts, because that's where I think the industry needs to change. And then we're going to have a change of dessert. So although I'd be happy to talk about the 7 regulatory sins, instead, this being a forecasting dinner, I want to be a little bit more specific about some of the forecasts that we would be making. So much of the focus in terms of risk in our industry has always been about investment management risk. And the big lesson from the credit crisis was that really was only part of the story. We've needed to think about credit, counterparty, and operational risk in a way that most institutions were not doing so before. We needed to think about rating agencies. We needed to think about the conflicts inherent in the rating agency model. We needed to think about market measures of risks. The rating agencies were arguably so far behind the curve in terms of recognizing the deteriorating credit situation that you actually had to be very observant as to what was going on in terms of credit default swap spreads to get you a better feel of what was going on in the credit picture. And we saw that a moment ago with slides showing the ballooning of Greece's credit default swap spread. And we needed to think about our clients. We needed to think about our clients because clients, when they had signed up to the mandates that they had done, had not themselves focused on credit, counterparty, or operational risks. And certainly for us as an institution, we felt a need to go back to those clients and to make sure that they fully understand the mandates that they had given us in terms of the risks that they were facing up to. Now, every institution had its own way of managing risk, and we at Schroders we turned over every single stone to try and find the methods that other institutions were using. And here's one that I think you will like. How's that for a way of controlling banking risk? Open only 4 hours a week. That is actually a true photograph. It was sent to me by a friend of mine down in the Caribbean, in the Bahamas. More seriously, there was another problem that surfaced in the credit crisis. When we mark prices to market in the valuations of collective investment vehicles, there is a presumption that should you wish to turn up in the market, you can trade in ordinary market size somewhere close to that price. And yet the reality was that during the middle of this credit crisis, in certain areas of the fixed income markets, if you actually wanted to trade in anything like ordinary market size, the price could move 10% against you. And under those circumstances, it is extraordinarily difficult to know how, when managing a collective investment vehicle, how you can reconcile the competing interests of those who wish to redeem, those who wish to hold, and those who wish to buy. And this, I believe, is a very serious issue that the industry needs to take time to consider. And certainly the CFA organization has been spending a lot of time thinking about this, and I hope will go to regulators on a proactive basis to talk about some of the control mechanisms that we may need to bring into play to provide a fairer outcome to our end beneficiaries. And there's a whole range of solutions, which I don't want to spend a lot of time thinking about tonight, but having a bid-offer spread can really help. There's a lot of marketplaces, particularly the United States, where there's a presumption that you really want investors to be able to come in and out at net asset value. That's a real problem when there is no liquidity and when the market prices mean very little. A bid-offer spread can help. There's the possibility that techniques that were used in relation to hedge funds could actually be used in relation to more ordinary mutual type funds when you run into serious liquidity issues. There's the possibility that we could engage with regulators to try and describe circumstances where there would be a liquidity event and where the industry as a whole might suspend redemptions. But all of these solutions, every single one of them, comes with its own set of problems. So, for example, if there were to be a liquidity event declared, what about an institution who had prepared themselves for it and who was perfectly able to continue to meet redemptions? Should they be disadvantaged? Or you have to think about other means of valuing securities. But there's a real potential pitfall. Because if we go away from marking to market and adopt some kind of fair value measures, what happens if the flow of redemptions continues and yet we realize assets at lower prices? The ongoing holders of that fund would continue to suffer. So, all of these have issues with them. I believe it's something that we as an industry together, collectively with regulators, need to address. It's sort of clear that none of us had envisaged these kind of circumstances that we went through in the fixed income markets. That has exposed serious weaknesses in our organization to handle these kinds of events, and it's something that we need to prepare ourselves for should these circumstances happen again. But now let me move on to the main course, just as the main course is being cleared, and to talk about the need for a totally new paradigm in the way in which institutional pools of capital are managed. I've been in this industry not for 40 years, but I've been in it for 4 decades, and I'm afraid I have reached the inevitable conclusion that the best practice standards applied today are badly flawed. So, what do I want to do here? I want to think briefly about what the problem is. I want to describe a sort of shorthand note for what is today's best practice model. I want to think what that says about our governance processes. I then want to get into the area of forecasting returns and thinking about what we do with those forecasts. So what's the problem? Well, the problem is that for any long-term pool of capital, the real benchmark for a pool of capital is never a market index. The ultimate benchmark is always the liabilities that you're trying to pay, whether it's a pension fund, whether it is an insurance company, or whether it's an individual savings pool meant to pay, for example, for college education. Now, the industry's emphasis has, for the last 40 years or so, has always been on beating, or if you're an index fund manager, matching market benchmarks. And along with that is an implicit statement that we want the market return. We're either trying to earn the market return or we're trying to beat the market return. Worse than that, parts of our industry focus on peer groups, but I'll put that entirely to one side. What I want to focus on for a moment is whether we're right to assume that we want the market return. So let's think about bond markets for a second. There is no bond market out there which matches in any way the liabilities of any particular fund. And generally, for most liabilities, market-related benchmarks are short duration, so we've actually been giving up a term premium if you believe that a term premium exists. More to the point, there is no financial theory, the equivalent of the capital asset pricing model, to suggest that you should want to own government bonds in their market capitalization proportions. And to do so in the area of credit is tantamount to deciding that you want to advance the greatest amount of money to the biggest borrowers. And for me at least, there's something inherently uncomfortable about that. And market-related benchmarks today no longer really represent the opportunity set. So we perhaps also could argue that yields now must be close to, if not at, near generational lows. So why, again, would you necessarily want to own an exposure to bond markets at this level? Take equities. This is global equities measured in dollars over the last 10 and a bit years. It's been a hell of a roller coaster ride. But against almost any market you can care to look at, we've had a significant negative realized equity risk premium over a period as long as 10 years. So are you quite sure that you really want that exposure on an almost permanent basis to equity markets?